The Reserve Bank of India's Monetary Policy Committee on 8th of June raised the policy repo rate or the repurchase rate, the rate at which the commercial banks borrow from the central bank. They have hiked these rates by 50 basis points to 4.9%, as it increasingly seems that the RBI will not be able to bring the inflation below the upper end of the tolerance band of 6%. The government has mandated that the RBI will keep the inflation around 4% in the medium term, with the flexibility of 2% on either upside or the downside to deal with any shocks to the economy. RBI Governor Shaktikanta Das said that there is a need for calibrated monetary action to keep inflation expectations anchored and restrain the broadening of price pressures. He also said that the decisions to hike the repo rate and remain focused on withdrawal of accommodation were unanimous. The Monetary Policy Committee has also changed the wording of the policy resolution on accommodation to say it remains focused on withdrawal of accommodation. This is the second time in little over a month that the committee has increased the repo rate. In May, it had increased the repo by 40 basis points in an off-cycle meeting. On inflation, the RBI projected that it would remain above 6% till the third quarter of the current financial year, that is 22-23, meaning that the central bank is likely to fail in meeting its inflation mandate. The RBI is deemed to have failed in its mandate if inflation remains above 6% for 3 consecutive quarters. Let's decode what are the takeaways from the RBI policy. The one very striking takeaway from the policy is the change in the policy stance that the RBI has made. They have removed the word accommodation and will solely focus on withdrawal of accommodation. This essentially means that during the pandemic, the Reserve Bank of India cut the policy rates by 115 basis points. The RBI therefore will focus on withdrawing this accommodation. So in a sense, so far, the RBI since first week of May has increased the rates by 90 basis points, leaving space for another 25 basis point rate hike in August when it holds the next review. But with inflation likely to remain elevated, the quantum of rate hike could be bigger and they may further change the stance to tightening. Now, what do these rate hikes mean for you and me, the consumer? First, the direct impact of the repo rate hike is on the interest costs that we bear on our home loans and car loans. Since most of the loans are now benchmarked against the repo rate, any hike in repo rate results in higher burden of interest costs on retail loans. For example, if you took a 12-year home loan at 7% for 35 lakh rupees during the pandemic, your EMI would be around 37,000 rupees per month. Your bank will either increase the EMI amount or the tenure of the loan, factoring in the 50 basis point hike in the repo rate. The second major takeaway from the policy is the upward revision in the RBI's projection of inflation in the current financial year. The central bank has upped its estimates by 1 percentage point and now expects the annual inflation rate to average at 6.7% in the current year. What the RBI says is that till June end, the inflation will average around 7.5%, for the second quarter 7.4%, for third 6.2%. Only by next year in January-March will it fall below 6%. Latest inflation forecast assumes that there will be normal monsoon and Indian crude oil basket will average at a price of $105 a barrel. These projections are largely driven by food prices. RBI said that around 75% of the increase in inflation projections can be attributed to the food group, since the CPI that measures the change in inflation rate from one year to another has a very heavy weightage of food and vegetables. The headline inflation is thus likely to be higher. The governor said that supply-side measures taken by the government in reducing excise duties on petrol and diesel, along with other measures, would help in mitigating the inflationary pressures to some extent. Third takeaway is the GDP growth. The RBI was more sanguine than what the economists expect about the GDP growth in the current year. It has retained its estimate of 7.2% GDP growth for the current year, which is lower than the government's estimate to 8.5%. The central bank highlighted a rise in its capacity utilization index, rising from 72.4 in December last year to 74.5 in March this year. This shows that the output produced with the given resources has improved in comparison to our manufacturing and production capabilities. In the last financial year, that is 21-22, India's GDP grew at 8.7%, maintaining the tag of fastest growing economy in the world. The fourth major announcement was on linking credit cards to the Unified Payments Interface or the UPI. RBI said that UPI has become the most inclusive mode of payment in India with over 26 crore unique users. In May 22 alone, transactions amounting to 10.4 lakh crore rupees were processed through UPI. At present, UPI facilitates transactions by linking savings and current accounts through users' debit cards. It is now proposed to allow linking of credit cards on the UPI platform. To begin with, the RuPay credit cards will be linked to the UPI platform. This will provide additional convenience to users and enhance the scope of digital payments. This is Shubham Batra for ThePrint. For more such videos, do log on to our YouTube channel and follow us on Twitter, Instagram and Facebook.